For more on this and other matters of the financial heart, we turn to Doug Dachille. He is the co-founder and chief executive of First Principles Capital Management. He's also a former managing director at J.P. Morgan. Doug, always great to be with you. Thanks for joining us. Before we get to munis and fixed income and all those wonderful good things, you've been reading about and following what's been going on with these insider trading cases. I thought that companies had many systems in place. They had great compliance officers. You couldn't pick up a pencil or move a paperclip without getting approval from someone. What happened?
I don't know, because that's why I like trading government bonds. There's not a lot of inside information that's associated with trading treasuries. I'm not inside on the treasury side, and since I don't really follow equities, the good thing is I don't have to get involved in any of those matters associated with insider trading. So when you're trading governments and agencies, municipal bonds are exactly the opposite. It's hard to get any information about what's going on there.
It's an opaque market.
You cannot get inside information. You cannot get accused of insider trading in the municipal market because it's impossible to get information at all. So maybe some of these people should take their social networking and bring it to the municipal market so we can all get better information around and make better decisions in the municipal market.
But are you surprised by this? I mean, because, you've been on Wall Street a long time. You know how the business works. I mean, is this just human nature at work?
Look, to be surprised, you can't be surprised by anything in 2011 after what you've seen in 2008. So being surprised about things that we've seen go on for 30 years, in 2008, we saw things that had never happened before. So something like this just can't surprise you at all.
All right, so let's start off talking about municipal bonds. The surprise there is that we haven't had more defaults, right? We had Meredith Whitney coming out, 60 Minutes. She goes on television and says they're going to be at least 100 defaults, municipalities, and I'm sure your phone rings off the hook. People want to know, what's going to happen to my investment?
It's actually quite ironic, because what you see happens is in the fourth quarter, investors saw two things. They saw their brokerage statements and showing their bonds going down, municipal bonds going down in value, and their municipal bond mutual funds going down in value, and they heard all this talk about weakness and municipal credit, that municipalities are going to default. Ironically, that is not news. The weakness of the municipal market and the municipal finances should be nothing new.
Doug Dachille, this idea that people are scared because they're not surprised about what's going on with municipal bonds,
they're scared,
but they're still scared because
they're scared for one reason. They're seeing the prices go down.
That's right.
It's hard to distinguish what the cause of the prices is what's causing the prices to go down. So what you see is prices going down and people talking about bad things in municipal credit. So naturally, people associate two things occurring simultaneously. They attribute causation. And we know that that's a flawed thinking, that just because two things are occurring through
You mean because two things occur at the same time doesn't necessarily mean that they're connected?
No, absolutely not, and let me tell you why. Because since municipal credit has been weak since we've been in this recession, I can show you numerous periods of time where these municipal bond prices were going up in price. In the first quarter of 2010, people were pouring money into bond funds. Actually, I would argue municipal credit situation was worse in the first quarter of 2010 and in 2009 than it was in the fourth quarter of 2010 when people started to think that, you know what, maybe the economy is turning. All these good things are happening in the economy, in the stock market. Because at the end of the day, municipalities are highly leveraged enterprises with respect to the performance of the economy. They're the equivalent of a beta 3 stock, for argument's sake. Because just think about their business. Think about their income statement. Their income statement, their revenue side is simple. It's driven by income taxes, which is going to be very dependent on employment, and also it's driven by consumption taxes like sales tax, also driven by employment. So when you have weakness in employment, at the heights of the weakness of employment, you're going to have bad revenues.
So this should be a good time, then, because it seems as though we're actually at least at a better stage relative to the previous 2 years.
People are thinking there's going to be growth, or maybe there's going to be inflation. But since we tax inflation, both are good for municipalities effectively because you get the benefit of better receipts. The problem with municipalities, unlike the private sector, and I hear people criticizing in the private sector municipal finance, but people have to understand the expense side. These are businesses that are in the business of providing essential services. They can't just in time shut down police, fire, water, sewer, because the revenue side of the income statement is shutting down. They have no choice. You can't go to odd, even days. If your house is odd, you can call the police. If it's even, you can't on that day. It's not possible. So the expense side of their income statement, there's not much they can do. So you have to understand that's part of the dilemma of being a municipality. The other thing that you have to understand is all this talk about pensions. Okay, well, if you think about the municipal pension, it's very simple. They own a lot of equities, and they fund it with a lot of debt. So when stocks go down and bonds go up, pensions get underfunded. But of course, when stocks go up and bonds go down, pensions become less underfunded.
So people should be a little bit more heartened by what's going on right now. Stocks are going up.
Exactly. So, all of these arguments suggest that that association may not actually be demonstrated of cause. Now, let me give you some insights into what could be causing the problem. The problem is people own bonds. Bonds go down because of interest rates going up, and bonds go down because of credit concerns. Well, in the fourth quarter, interest rates went up. Now, you see, when you look at your statement, interest rates went up, the price went down. You hear all this noise about municipal credit deteriorating. You naturally assume that the price went down because of credit. The reality is, the problem with the municipal market is, and it's because of the structure of the tax code in the United States, the municipal bond market is almost entirely owned by individuals.
Right, not by corporations, because that has to do with the tax code.
Right.
They are disincentivized. I hate using that word, but they don't have an incentive to actually go and buy tax-exempt bonds.
In 1986, the tax code was changed to create a disincentive to prevent corporations from owning tax-exempt assets and financing them with tax-deductible debt, because, of course, that would create a subsidy. A guy could buy a 4% yielding bond, tax-free, finance it at 4%, but he'd get the deduction for the 4%, so he would enjoy 35% of 4% free. So the government didn't like that. So they created this disincentive to prevent leveraged U.S. corporations from buying municipalities.
So that includes banks. It also includes
life
pension
insurance
funds.
companies. Well, pension funds are tax-free.
They don't have to worry about it anyway.
Right. With pension funds, they don't want to buy municipal bonds because the yields are too low because they're tax-exempt. So pension plans don't buy them. Banks have a disincentive to buy them because there's this.
So it's only mom and pop. It's only individuals who really are buying municipal bonds. And when they sell, there's nobody on the other side of the trade.
Right. The big investors in fixed income in the United States are banks, life insurance companies, and pension plans. Pension plans we talked about won't do it. Life companies have a very onerous disallowance to prevent them from buying municipal bonds. Banks have this disallowance that was enacted in 1986. Prior to 1986, banks were the biggest owners. So you wind up getting this situation. You look at your statement. You hear municipal credit must be weakening, even though it's probably improving. And you do the natural thing, sell. And when you try to sell, I can only call you to sell. So the only thing that can happen is I can get that price to go down enough to motivate you to stop selling. That's what happens in the municipal bond market. So the tax code prohibits the deep capital to come in and actually support the market and provide investors liquidity, because it's just everyone providing liquidity to themselves.
So does this mean there has to be a change in the tax code?
Well, it's interesting, because if you think about it, the Build America bond program was designed to try to help this, because what's happening is you have all these people crowded into the tax-exempt market, which is mom and pop and individual investors, and that exit door is very, very small when everybody wants to get out. So what the government decided to do is we're going to try to take some of the we're not going to try to add more crowd to that tax-exempt market. We're going to allow issuers in the municipal market to issue in a different room. We're going to allow them to issue to taxable investors, and we're going to cut a 35% subsidy check to those investors who buy these taxable bonds. Well, who naturally is going to be the buyer of those taxable bonds? Of course, people who don't pay taxes. So at the end of the day, what happens is the government writes a 35% check to those people, which is very similar to the thing they tried to shut down with U.S. corporations in 1986.
The law of unintended consequences.
We might as well write the subsidy and give it to U.S. corporations instead of foreign and non-taxpayers.
Doug Dachille, this idea that, all right, most of the investors in the municipal market, the tax-exempt market, are individuals. And when all the individuals want to sell because they're concerned looking at the principal on their statement, there isn't a big institution on the other side who's got an incentive to buy. One of the other things that individuals have been at least taught or coached to do is only buy tax-exempt bonds of the state in which they live. You're shaking your head no. This is a big bad thing to do. Bad thinking. Why is it a bad thing to do?
What happens is most people are told to do that, and they don't really think about the economics. both the reward and the risk, okay? I mean, the reason you're doing that is because you can avoid, when you own bonds in your resident state, you don't have to pay tax to your resident state. Because if you own a bond, you live in New Jersey and you own a New Jersey bond, you don't have to pay tax to New Jersey on that bond. But if you buy a bond from Florida and you live in New Jersey, you're going to have to pay income tax on that bond. Well, what people...
State income tax, not federal income tax.
Right, all the bonds are federally income.
Exactly.
But no one does the calculation. How much is that really worth? How much benefit are you getting? Well, if a bond is 5% and your tax rate is 10%, well, okay, that means it's 10% of 5, which is 0.5%. But remember, you get a deduction for your state income taxes at the federal level, so you really only pay 65% of that number. So you're really only paying 30 basis points. So you're only paying 30 basis points. So the question you have to ask yourself, first of all, am I willing to earn an extra 30 basis points to have no diversification? That seems pretty modest, a low level of return when you're thinking
0.3% to not have a diversified...
absolutely no diversification. And that's just on your investment portfolio. Don't forget, you live in the state. If the state doesn't do well, they start cutting services. They start potentially raising taxes. So there's a whole... You might be operating a business which is experiencing a downturn. So there's a whole host of other bad things that can happen that are related to your investment portfolio. You never want to have your investment portfolio, especially for 0.33%, heavily tied up in your resident state because you have so many other activities associated with the state. Then the worst thing that people forget is, let's hypothesize we've heard people talking about default. These municipalities are going to default or they're going to do a restructuring. Okay, well, there's two possibilities. If a municipality can't pay its debt, there's two possibilities. In certain cases, it'll consider trying to do a restructuring. The other alternative is raise taxes. Well, if you own the bonds in that jurisdiction that's raising taxes, so it prevents a default, that's just you paying yourself back. That's the equivalent of a default. So you don't want to own the bonds in the state that's going to do that. You're actually indifferent. If you own the bonds in the jurisdiction that's experiencing a default or a restructuring, you're actually indifferent between them raising your taxes to pay off your debt. You're really no better off. Or they just say, we're not going to pay you off.
Back,
right. And the only difference is I actually prefer taxes over loss on my bonds, because when you have your taxes are deductible against your ordinary income. But with a loss on your bonds, that's a capital loss, which is only offsettable by capital gains. So it's actually harder to take capital losses than it is to take deductions of your state income taxes, assuming certain other phenomena. So you really don't make money by having such concentration in your resident state for such a de minimis amount of compensation. It makes no sense.
All right. Now, I want to talk about, you mentioned the word default, and I want to get your thoughts on a group of, well, financial institutions that allow speculators to speculate on the default of municipalities. This has to do with the role of banks and credit default swaps, a sophisticated instrument which most people don't deal with, except if they're already sophisticated and know what they're doing. But this allows people to bet on the default of a municipality when indeed the banks, don't they benefit from the largesse of the state institutions?
Quite interesting. I mean, if you think about it, we kind of had that product, but done in a different form. We had bond insurance, right? Bond insurance was effectively, but it was attached to the bond. So you knew that there was a perfect connection between owning a bond and somebody buying the protection. The problem with the credit default swap market is that linkage is not there. And in many cases, it could be even perverse. So take a bank or a financial institution. Banks and financial institutions do lots of business with municipalities. For example, they provide lines of credit, liquidity, so these municipalities can go finance in the variable rate demand obligation market. So they have a lot of activities that they're involved with. So would you really want them to be engaged in the credit derivative market when what they could do is say, well, you know what? We don't really want to extend your line of credit anymore. And of course, you know the consequence of that with respect to the CDS. So the conflicts are horrible. And it's not like the old municipal bond insurance business where there was linkage. If there's linkage, if a guy can come to you with a bond and get CDS, that's one thing. But if a guy's just taking a flyer and doing a bet on CDS, and that's a very different situation.
I want to thank you for shedding some light on the marketplace. Municipal bonds, always a pleasure.
Thanks.
Doug Dachille, First Principles Capital Management.